You probably think your bank makes money from big investors or fancy loans, but the truth is, they make a lot of money off you just for having a regular checking account. Let's break it down. First, the obvious one, fees. Overdraft fees, ATM fees, monthly maintenance charges, minimum balance penalties. These aren't accidents. They're a business model. In fact, US banks made over $11 billion from overdraft fees alone last year. That's more than the entire US coffee industry. But here's where the real money comes from. Interest spread. You deposit money and they pay you, 0.01%? Then they lend that same money out as a mortgage at 6% or a credit card at 20%. The gap between what they pay you and what they charge someone else. That's called the net interest margin, and it's often their single biggest source of profit. For many banks, it's billions of dollars every quarter, quietly, invisibly. And there's one more stream you probably don't notice, interchange fees. Every time you swipe your debit card, the merchant pays the bank a small cut, usually a fraction of a percent. Doesn't sound like much, but across millions of customers and swipes, that adds up to billions more. Here's a fun fact. Some banks have started designing checking accounts not to serve you, but to serve algorithms. They optimize how your transactions get routed, how fast they settle, and how long your deposits sit, all to squeeze out just a little more profit from your money sitting still. So what can you do? Avoid banks that charge fees. Look into online banks or credit unions that actually pay interest. And check your last 3 statements. You might be surprised what you're quietly paying for. If you want to see how these traps are built into your checking account itself, check out the next video in this playlist.